All right. Hi, everybody. My name is Richard.lesperance. I go by the name of Vibrant Richard. Welcome to A Better Lifestyle. Today, I have the pleasure to have Katie Weldon. So nice to have you on the show, Katie.
Thank you for having me. I appreciate it.
No problem. So tell us a little bit about yourself and we'll get started.
All right, great. So my name is Katie Weldon. I'm also known as Katie the Mortgage Lady and Coach Katie. And I've been in the mortgage industry for about 11 years now. And we have done a lot of transactions. So I'd like to think that we've seen pretty much everything that there is to see. And with that comes a lot of creative solutions for people who might not realize they have options right now. So really, I'm just looking forward to chatting about those solutions for people because I feel like there's a lot of clients who were even denied at other lenders who might not realize what's possible for them.
All right. So we were talking before there was supposed to be a presentation, but we kind of figure it out. Talk to us about the different types of creative financing that people should know about. I know you have the 2-1. Let's start with the 2-1 buy down.
Yeah, absolutely. So a 2-1 buy down is when a seller basically pays the difference in your mortgage. So let's say your mortgage is at 6.125, they pay 2%, so you get a 4.125 interest rate for the first year. And what they do to do that is they actually take your savings and pay it up front. So for easy math, let's say you're saving $200 a month for a year. $200 a month times 12 months would be $2,400. So they're taking whatever it is you're saving. Usually it's more than that. And the seller's giving you a form of a credit to do that. And what it allows clients to do is get into a home, pay a lower interest rate for now and feel more comfortable when rates improve so that they can refinance and get into something different. The downside to that is it's not a fixed rate, so you're only buying it down for a short amount of time. So oftentimes the most common one we do is 2% for the first year and 1% for the second year. So it gradually goes up and then it goes up to the market rate again after that time. So it would start at 4.125%, then be at 5.125%, and then be at 6.125%. So basically the seller's prepaying the difference in your mortgage in a separate account. Does that make sense?
Okay, yeah. So I guess once that's done, then they go back. They have the choice to have a fixed rate or variable rate.
No, it becomes fixed from there. It becomes fixed at the highest interest rate. So the downside is also those programs have higher interest rates to start. So you could get a lower fixed rate just by having the buyer or the seller pay extra at closing. So it really depends on the market. There was a point where those programs were a lot more competitive. It depends on where rates are at. But knowing that we have these programs just allows us to really look at what's best for that client based on rates as of right now. But like as of today, I might not recommend that because the market rate is a fair amount better than what you get on the 2-1 buy down. So you'd be getting a higher rate to start.
And we were talking before about the down payment assistance. Can you talk to us about that?
Yeah, so our company is #1 in Massachusetts for down payment assistance, but we do down payment assistance in a lot of different states. We do the state bond program specific to each state, and then we have other programs that provide the down payment. So they all work a little differently. When you're working with a state program, you're usually going to get better terms. So they'll have very low interest rates on the second loan, or it may be a grant that's forgiven in a certain amount of time. I'll use Massachusetts for an example. They have one loan where you can get $30,000 towards the down payment, and it's at 0% interest. And so a lot of the state bond programs, they're run by the state, they're nonprofits. They want to get people into homeownership. And so they're really competitive. We also do just regular loans with down payment assistance, specifically FHA. And the way that looks is you have the second loan at a higher interest rate than the first, but it gives you the money for the down payment. So this is really great for my clients who maybe bought a house recently, but don't have a ton of equity to get out of it. So they don't have the money to buy the next house. So I'm seeing that a fair amount, or I'm seeing divorce situations where the spouse gives all of the equity into to their spouse so that they can buy him out one time and they don't have the funds to put down on the next house. So we've been using, I think I'm on my third or fourth this month, we've been using that program a lot because it can help people get into homes right away. They don't have to come up with a down payment, or maybe they have a little money down, but don't have the money for the closing cost. So we can use that assistance for whatever we need that assistance for.
Okay. And you also have price, I think it's price reduction and sales concession.
Yeah, so this is something that comes up a lot when a house has been sitting on the market for a while. They'll ask their realtor kind of like, what do I do next? And everyone says, you've got to reduce the price. It's priced too high. But the seller could be leaving a little money on the table because they may actually capture the right buyer by giving them credits towards closing because they could get a lower interest rate from it. You could capture a buyer who maybe wanted to buy a house, but they got frustrated because they were asking sellers for help towards closing costs and they weren't getting it. So rather than reducing your price by $10,000, if you give a buyer $10,000 towards their closing cost, they're in a much better long-term position because they can use that in so many different ways. The only caveat to that is the house still needs to appraise for that amount. But if you reduce the price by $10,000, you would have been in the same boat anyways. So we think it's worth the risk. And that's always going to be what I recommend to start is instead of reducing a price, try giving a credit and see if you can capture a different buyer from that.
What about the seller seconds?
Seller seconds, I saw a lot more of, I want to say around a year ago, but we're still seeing them here and there. And what it's doing is people have so much equity in their homes that they're allowing buyers to take a first mortgage, but maybe bridge the gap between what they could have afforded or what they had down to get better terms. And they're taking out a seller second. So I always recommend you have an attorney involved drawing up the terms properly because you don't want to get screwed and the seller wants to be protected as well. So you want to make sure this is not something you're just doing with an agent. You need to have an attorney involved to draw things up properly or a title company, making sure things are legally binding. But they're doing shorter terms, 5 years, 10 years, and they're saying, okay, great. I know you're $30,000 short. We'll give you a second loan for that amount and help you finance it so that you can get approved. So I'm seeing those happen after the fact as well. It's not necessarily something someone wants to offer right up front because there's a lot of risk on a seller, but to keep a deal together, it's a great option to keep in your back pocket.
What about rehabilitation loan?
Yeah, we do a lot of rehab loans, and these are amazing because people sometimes think that when you're doing a rehab loan, you just have to do something like the roof or the hot water tank, and they don't realize there's even options to put a pool in. So in Florida, I can tell you that's very sought after. The tricky part is when you're financing a house with rehab work, it has to be worth a certain amount after you're done. It has to sustain its value. So if you're buying a house for $300,000, putting in $100,000 pool, that house better be worth $400,000 at the end. But the way these loans work is they take the mortgage for purchasing the house, and then you take the cost for all of the renovations and repairs, and they lump it together. So the way I explain it to my client is this is a new purchase price, right? So if you're buying it for 300 and you have 100,000 in renovations, you're essentially buying it for 400 because that's kind of what we're basing it on. And most of the times I'm seeing, depending on the right renovations, I'm seeing the appraised values come in higher because people put a premium on having everything done. And when they see a house that needs a lot of work, they can sometimes take away the value in their minds. So this is a great option when people are finding a house that fits a lot of their needs, but maybe not all of them, or it fits a lot of their needs and yet they're still not able to do renovations after because of the price points. So it allows them to do really whatever they want. And you can do additions, new kitchens, bathrooms, finish a basement, and it really gives them flexibility to do it all before they move in too.
Talk to us about the VA loans.
VA loans are 100% financing, so our clients don't have to put in any money, and a lot of them get seller's credits towards closing costs as well. So some of my veterans are coming up with just the deposits, and then they're getting those back after closing. And the great thing about that is they have better rates right now I'm seeing than market rates. Their guidelines for their appraisals protects the buyer. So they make sure that the house is in livable condition and there's nothing immediately concerning that needs to be completed. And 0% down. So all of the VA loans are 0% down. And so people don't need, even if they have the money, they're using that money to pay off debt maybe, or they're They're using it for renovations later on. You do have to be a veteran. There's a certain amount of service you need to complete to do those loans. But once again, just another tool in our toolbox. We also do USDA loans, which are 100% financing in certain areas of the country. It has to be a kind of a rural area. And those are a great option for people as well with no money down.
Okay, yeah. So I was gonna talk about the no money down. So what are
Yeah.
the other options like for no money down when it comes to no money?
Yeah, so no money down would be USDA, which is in certain areas. It would be VA, which you have to be a veteran, and it would be the down payment assistance loans. So it could be the state bond programs, or because everything requires quote unquote like a down payment, so to speak. But there are certain guidelines, like with the USDA being in a certain area, it almost like gives you that help that you need to purchase the house. So the down payment assistance, I would classify as a no money down loan as well, because you're not bringing the money. It's all being financed still, even though it's in two separate loans. So some of the loans just have one loan that people get, and others have a combination of loans.
So all these options, I know it's not every states that can get those loans, right?
They are available in every state. You just have to find lenders who are knowledgeable about them. So if there's a state you're looking for in particular, if we're not licensed there and we don't have that program, I can easily find someone who's familiar with the state bond programs, if that's what it is. So they're available in all the states. They just look different. So for example, the mass housing one is one of the better ones in the country. I do Florida housing as well, New Hampshire housing, Maine housing, Rhode Island housing, Connecticut housing. They're all different. So we're mainly licensed in New England and Florida, and we have connections all over the country for anyone's mortgage needs. So they're out there. You just have to make sure you're using a lender who can offer them.
So what about someone if they have bad credit?
So bad credit can lessen the options you have available. Most of them have a minimum credit score. There are still low down payment options available, as low as 500. A 500 credit score, you need 10% down. A 580 or more, you can put 3.5% down. And the down payment assistance goes down to 600. So what I tell my clients is, let's just see where things are at so that we can work together, because the reason people's credit are low is because they had an issue at one time or another paying bills properly. So let's get you in the right position to be able to work towards things and put a plan together so that you can ultimately buy, even if that's not right now.
And with interest rates that are high, is it a good time to get into those options?
Oh, I think it is, because what you're going to see is, as interest rates lower over the next year or two, there's going to be a lot of pent up demand. So there's going to be a lot more people going out there who have been waiting, and you're going to see prices rise again. And so what benefit are you getting if you're getting a lower interest rate for a higher purchase price property? That it negates each other. And so if you can get into a home now, what you can do hopefully is refinance once that opportunity comes available. I always tell my clients, you cannot bank on refinancing, but if you are able to do that once the time is right, like, we're ready to do that for you.
Any mistakes you see people do when it comes to those things
I see a lot of people refinancing too early right now. They just bought a house a few months ago and they're refinancing to get a better rate, and they're missing an opportunity because they're going to have to refinance again once rates go down again. So I always like to see a certain amount of improvement to make it worth it. $100 a month to me is not going to it's not going to move the needle enough for a client long term. So I would wait a little bit longer to see more movement in order to refinance them. But there's a lot of lenders jumping on a refinance bandwagon and just refinancing everyone they can talk to. For me, it's more about a long-term relationship with my client and making sure that they're protected and I have their best interest in mind. And if my sister was refinancing right now, I would say, listen, you should wait. Don't do it right now. Unless there are some people it makes sense, but I would say it's not as normal as just an everyday person. I would say 20% out of 100 makes sense to actually refinance now versus later.
All right. Where can people find you on social media or the internet?
Yeah, you can find me at Katie Simpson Weldon. So it's KatieSimpsonWeldon, or on my website, katieweldon.com, has a link to all my stuff, or Team Katie, TeamKatie. All my links are always there, so you can find, I'm pretty easily searchable on the internet. If you look up my name, like there's no lack of my presence. I'm everywhere.
No problem. Thank you, Katie, for your time.
Of course. Thank you so much for having me.
No problem.
All right. Bye-bye.
Bye.